So the formula I wrote it here. Value of right is equal to TERP minus issue price. Okay, issue price is $6, $6 million. So TERP is calculated. So TERP is value of existing shares. So the value of existing shares is calculated as 5 million into 8 plus the new shares are 1.25 million. We calculated that because for every 4 shares there is one share which is given. So 1.25 million, that is 5 million divided by 4. So additional 1.25 million shares were issued, but these are issued at $6. So this entire thing divided by all together 5 plus 1.25 is 6.25. The number of shares are 5 plus, so we can put it as 5 plus 1.25 million. The entire thing calculated is TERP. So from TERP, the new after the fraction is calculated 1.25 million, we have 6.25 million in the denominator. So this entire thing would be the fraction, and that is TERP. So TERP minus the value of new issue price is $6. So that is deducted. We get what is the value of right. But the question says what is the theoretical value of rights per existing share. So per existing share, we got $1.60 per share. So how many shares are there? So the formula of value of a right per existing share, if we are looking into that, the formula given is okay. Okay. Now we're able to see the screen. Value of a right per existing share is equal to value of a right divided by number of shares needed to have a right. So how many shares are needed to have a right? It says that the right is possible only when there are 4 rights. One share would be issued when there are 4 shares existing with the shareholders. So now we have the value of right calculated here as 1.6. Do you see that? Fine. 1.6 divided by how many shares are needed to have the value? So the answer is Please make a note of this answer. Only 3 joined. Today also there is some problem. Is there any problem?
No, ma'am, I have no idea about this. Why others haven't joined?
Maybe it is still cold there. This is in Punjab, no? Your university?
Yes, ma'am.
The weather must be quite cold.
Yes, ma'am.
Do you also have hot weather during summer? The weather is severe or moderate?
Yes, ma'am. In June, July, the weather is quite severe.
Okay. So you got adjusted to all the extreme weather conditions.
Yes, ma'am. In winters, we have severe winters, and in summers,
So
there.
how low will the temperature fall?
Ma'am, in summers, it approximately goes up to 45,
Oh.
and in winters, it sometimes touches to 3 degrees at night.
Then let's look at the next question. One or two we'll work it out, and then we'll go to the next topic, CAPM. So from the list, we see question number 133 is how to calculate what is the total shareholder return, and 134 is what is cost of equity of car company. So let's take up these two questions, work out, and then I'll start with the next topic. So I've pasted these two questions here in the Excel sheet. The question says Green Company, a listed company, had the following share prices during the year ended 31st December 20x5. At start of 20x5, 2.5. Then at highest price in the year is 3.15. Lowest price in the year is 2.40. At end of 20x5, $3. During the year, Green Company paid a total dividend of 0.15 per share. We are asked to find out what is the total shareholder return. Because we are learning about the share capital. So this is one concept. The concept of shareholder return, which is discussed here, is asking us to calculate the total return. So what does it mean by total return? What is that the shareholder receives when he invests in the share capital? So periodically he receives a dividend amount. Okay. Then if he is investing at the um, in the shares at the beginning of the year. So as against this investment of 2.50, which is investing at the beginning of the year, he is entitled to receive a dividend. How much is the dividend? Dividend is 0.15. So that is one benefit. So one return is when he invests this 2.50 at the beginning of the year, at the end of the year, this is what he gets. So that is the dividend return. Periodically he gets a return. So the return is compared with what is the investment he made, and uh, then we understand what is his return. Then apart from that, there is also another return which he's not realizing now, but if he realizes, that is what he gets the benefit. Now he invested at 2.5. Okay, during the year there were ups and downs. We know that the share prices fluctuate, so there were it went up to 3.15, it went as low as 2.40, but nevertheless by the end of the year this 2.5 has increased to 3. So as of now, if he sells the shares, he can get a benefit. How much is the benefit? The difference in the price. While investing, he's invested only 2.5. Then at the end of the year, the value has risen to 3. So that difference is the capital gain. He's investing 2.5. He would get 3. So there are two returns. One is the difference in the capital value, and the second one is the dividend return. There are two types of returns which he is entitled to. That is total shareholder return is equal to dividend return. He would get a return in the form of dividend, plus also he would get the difference in the capital value. So um, capital gain return. How would we write this one? So the dividend return would be, he has invested 2.5, as against 2.5 he is getting 0.15. So we write 0.15 divided by 2.5 plus, he has invested 2.5, but then the value has risen to 3. 3 minus 2.5 is his benefit. So 0.5 is his benefit as against an investment made for 2.5. Okay, do you see that? So we can calculate this as, the denominators are same, 2.5, 2.5. So the numerators will be 0.5, 0.15 plus the difference is 0.50 divided by 2.5. The total return what he can get by investing in the shares is 26%. So total shareholder return is equal to dividend return plus capital gain return. So we got it as 26%. The next one, the next question is question number 134. So 134 says that car company has announced that it will pay an annual dividend equal to 55% of earnings. Its earnings per share is 0.80. Then it has 10 million shares in issue. The return on equity of car company is 20%, and its current come dividend share price is 4.60. What is the cost of equity of car company? Let's note down what are the details which are given. Okay. It has announced that it will pay an annual dividend equal to 55% of earnings. 55% of earnings. Its earnings per share is 0.80, and it has 10 million shares in issue. The return on equity is 20%. The dividend share price is 4.60. Fine. What is the cost of equity formula? Do you remember what is cost of equity formula? Cost of equity is equal to
Ma'am, dividend into 1 plus growth.
dividend into 1 plus growth, because it
Yeah.
is d1 by p0 plus g. How do we get d1? D1 will be the last year's dividend into 1 plus growth gives us d1 divided by p0 plus g. So it's on the screen. The cost of equity is equal to d1 by p0 plus g. So let's get back to the Excel file. D1 by P0 plus G. Okay. Uh, let's define the terms here. What is the earnings per share? Earnings per share is equal to, it's given as 0.80. Then they are promising to pay a dividend of 55%. So the dividend DPS, what we call it as DPS, or this is equal to 0.8 into 55%. So that would come up to, okay, the company has announced that it will pay an annual dividend of 55% of dividends. Its earnings per share is 0.8 and it has 10 million new shares in issue. The return on capital, uh, the return on capital, return on equity of car companies 20%, and its dividend share price, current come dividend share price is 4.60. So that is what is mentioned. What are the things we are supposed to know? First thing is we need to know what is the dividend amount. Okay, then we need to know what is the current market price. Then we need to know what is G. So there are three variables for us to calculate. In the formula, we need to know what are the three variables. First variable is D1. Okay. Second variable is P0. What is P0 is what we need to know. The third variable is growth. Do we see all the three present there? We do not see anywhere what is G. G is not there anywhere. Okay. The company has announced it will pay 55%. Its earnings per share is 0.80. So when it has earned 0.80, as against that, we have calculated the dividend amount to be as 0.44. Okay, but then 0.44 has to again grow at the growth rate, but we do not know what is growth rate. So growth rate is equal to, there is a formula for growth rate also we have discussed. I asked you to remember the second one, that is G is equal to return on equity or accounting rate of return on equity, whatever it is, some return into the proportion of funds retained. So that is retained earnings proportion. So G is equal to R into B. G is equal to R into B. Okay. Now what is R? R do we know? R is given. R is equal to we have R is equal to 20%. B is equal to, they have announced to pay 55% as dividend. So how much is that they're not paying? 1 minus 55%. So B is equal to 1 minus what they are paying. They are paying 55%. Okay. So what is that they are not paying is equal to 1 minus 0.55, which is equal to 0.45. So G is equal to, we just have to multiply these two values. Okay, G is equal to R into B. R into B, we got it as 9%. Okay. Now, the D1 part also has to be increased as D1 is equal to D into 1 plus G. That has to be calculated. Is equal to, we already got D to be as dividend per share to be as 0.44 into 1 plus 9%. So we got dividend D1 as 0.4796. So D1 we know. We know what is G. Do we know what is the what is P0? That is the next variable. P0 is equal to, current current come. So added together, current come X dividend current come. So both the current market price plus the uh, dividend value is included in the share price, and that stands at 4.6. It is just not P0. It is P0 plus the dividend part also included. How much is the dividend? The earnings which are included in the share price is 4.60. So the share price of 4.60 includes the dividend value as well. So here, because it is current come dividend share price 4.60, we will have to deduct from 4.60 what is the dividend amount. How much is the dividend amount? We have that to be as 0.44. So P0 stands at 4.16. P0 is equal to 4.60 minus 0.44. Now, once we know all the three variables, we know what is D1, we know what is P0, we know what is G. Substitute all of them. So, 0.48, let's make it as, divided by P0 is 4.16 plus the growth rate is 0.09. So, add it up. So we have cost of equity as 20.5%. Cost of equity. Cost of equity has only three variables in the formula D1, P0 and G. But To arrive at these three things, nothing is mentioned, no value is directly stated. D1 is not given directly, P0 is also not given directly, and then we also see that G is also not available. So then first we have worked out on calculating what is D1. So taking the earnings per share at of the earnings per share, 55% is paid as dividend. So that comes up to 0.44. Then D1 is calculated as dividend into 1 plus growth rate. But growth rate is not known to us. So we started working out with the growth rate. Growth rate is equal to R into B. R is the return on equity, which is 20%. B is equal to the retention ratio. If they are paying 55% of earnings as dividend, they are not paying 45%. So that is 1 minus 55% is 45%. 45% they are retaining. So growth is equal to return into um, the retention ratio. So return growth is 20%, retention ratio is 0.45. So multiplying both of them, it is 9%. We got it as 9%. Now, P0 is also not straight away directly given as current share price. It talks about current and the dividend value included. It stands at 4.66. So dividend value we calculated DPS is 0.44. So deducting 0.44 from 4.6, we get the value as 4.16. After all the three variables are calculated, we solve this cost of equity to be as 20.5%. I hope it is clear.
Yes, ma'am.
We'll continue with the topics from the PPT. So the weighted average cost of capital, yesterday we've learned about it. Proportionately, the weights are multiplied into cost of capital divided by the total capital. So we have worked out one question. So later on, if time permits, we will take up more problems and solve them. The next topic in cost of capital is calculating the cost of equity by a model given by a model called as capital asset pricing model. So capital asset pricing model is a way in which the return on or the cost of equity or the return on equity can be calculated. For this particular model, the risk is taken into picture. So risk is calculated as the systematic risk and unsystematic risk. But by any chance, do you have an idea about what is a risk? Any one of you have any idea about what is risk? Okay. Now, when future values are anticipated, if there is any variation in the future values which are anticipated, now day-to-day life experience, let's say that it is expected that it would rain today. So that is an expectation. But if it could also be that it would not rain. So that is, if you have planned everything according to that, it would be rain. And if there is a variation that it has not rained, then the plans would not be taken up, because you have planned only when it would rain. See, for a business, they might have planned as they would be able to sell 10,000 units. But because the demand was not very good, they were able to sell only 8,000. Or the demand was too high and they were able to sell 12,000. So, if there is a variation, So at the time of planning itself, if they understand that there would be a variation, it could be high or it could be low, because there are certain things which are prevailing. So there are chances that it will increase, there are chances that it will decrease. And you also know that what is the percentage of chance that it will increase or it will decrease. So then you tend to calculate what is the amount of risk. Risk is the cash flows into the probability, the chance that that would happen. So when you multiply these two things, we get what is the amount of risk. So that is basically the concept of risk. Now in case of investing in stock market, it is subject to risk because there are too many variations, there are too many fluctuations. Just now we have worked out one question wherein we saw that when 2.50 was invested during the year, there were fluctuations. It went as high as some 3.15, as low as 2.40. So which means that there are ups and downs, there are chances that the price rises, there are chances that the price falls. So that variation, those variations which happen in the stock market, now that causes risk. When it goes upwards, there is benefit, but when it goes downwards, it is a loss. It is a loss arising because when they have invested with an expectation, it is not the same, but there are variations taking place. So risk is present in case of investing in a stock market. But CAPM model goes one step ahead and says that first the total risk has to be identified clearly as what is systematic risk and what is unsystematic risk. Systematic risk is equal to, it says, systematic risk is equal to market wide factors, okay, such as the state of economy. Unsystematic risk is equal to company or industry specific factors. So here if we are talking about systematic risk, the risk which occurs to everyone in the economy, or all those businesses, they get affected, so uniformly there would be an impact. um, in that such type of risks are called systematic risks. So uniformly everybody gets affected because of the change in taxation policy. Then it is not only specific to only one particular industry, taxation policy will affect all the businesses. So the variation in the profits which they would have will differ. Now that the variation will be seen by all the companies. The cash flows will differ now. Earlier whatever cash flows or profits which they had would not be the same, it would be little less. Why? Because there is a taxation policy which has come up. So more amount of taxes paid, more amount of taxes are paid by all the firms, all the companies pay. So all the companies profits get affected. So we see that impact on for all the companies across the country. So when a risk arises and it impacts all of them, we call them as systematic risk. So that is a variation caused in the profits. Why? Because taxation has risen. But it is not only to their company, it is to everybody. Everybody gets affected because of that. So systematic risk is market wide factors which affect everyone in the economy, every business in the economy. But there are certain things which affect only a specific company or a specific industry. Let's say that there is a subsidy given to agri firms. So those companies which are agriculture based, they get a subsidy. So there would be a variation in their profits. That is, they get benefited or they are not benefited, but specific to only one particular industry, or subsidy was withdrawn to what was given to some industry. So um, then in that case, the specific component making industries are not entitled to subsidy. So it is affecting only to one particular industry, one segment, one type of company. So in that case, such risk is called as unsystematic risk. So, unsystematic risk talks about company or industry specific factors. So, CAPM model first talks about identifying the total risk as systematic risk and unsystematic risk. It is divided into two different types. So, by holding a diversified portfolio, investors can almost eliminate unsystematic risk. Okay. by holding a diversified portfolio. So what does it mean? Diversification, you must have heard about that. Diversification is, instead of investing all your investment in only one type of investment, spread across many types of investments. So divide the amount and put it one portion into one type of investment. So in that way, you can minimize your risk. That is the concept. There is a saying which says that do not put all your eggs in the same basket. If the basket falls, all the eggs will break. So these eggs should be kept in different baskets. So even if one basket gets affected, also the other ones would be safe. So that is the concept behind that. So portfolio also talks about the same thing. Portfolio talks about diversifying the investment. Instead of putting the entire investment in only one type of security, spread across many securities and put the investment, so that if, even if one investment doesn't do well, the loss from one investment can be nullified or negated with a profit or gain from another investment. So that is the concept. What is about the portfolio management. So by holding a diversified portfolio, investors can almost eliminate unsystematic risk. So here the suggestion talks about, don't just go by investing into those investments which have unsystematic risk. Also go and invest into those investments which have a systematic risk. So even if the unsystematic risk is affecting this particular thing, there is another thing which gets benefited, because there are certain things which are not um, only that industry oriented, but they may get benefit from some other type of investment. So that benefit from other type of investment can eliminate, can negate, can nullify whatever is the loss which is arising on account of unsystematic risk. That is the concept which is explained by CAPM. So CAPM further goes on and explains uh, with a graphical model. Here we see the number of securities. One to, instead of investing only in one type of security, they are spread across many securities. So if once one in one security, if the investment is there, the total portfolio risk, it is high at this particular point. The security, the investment into one security is at this level. Okay. um, the total portfolio risk is at high if it is invested only in one security. As the number of investments keep increasing, here we see, as the number of investments keep increasing, we have observed that the unsystematic risk, which is very high, it is coming down, and it stabilizes, at this particular point. Okay. So whatever was unsystematic risk affecting only one type of industry, that can be adjusted, that can be eliminated, that can be settled at one particular level by spreading this investment across many investments. So instead of investing in one security, here we see that maximum of 15 to 20 securities are taken. The total amount is divided. So one part is invested into one type of um, security. So the benefits which are received from others, and even if there is a loss which is arised from one particular type of security, that can be substituted um, with the gains which are received from um, those securities which have systematic risk. So that is the concept here. Now that concept is also explained with an equation. Okay, the equation is given here. The formula for CAPM is given as expected return on equity is equal to risk-free return plus beta into expected return from the market minus the risk-free return. I'll just explain you the formula. So this is what is the formula. But before the formula, so there is a concept of beta. Beta is given here. There is a concept of beta which is calculated. Okay, that is the explanation what is discussed in the previous sheet. Okay, in here it says that investors should therefore only be compensated for systematic risk. CAPM uses beta value. What is beta? So first thing is we need to understand what is beta. Beta value of a share is used to measure the systematic risk. So we've discussed that risk is of two types. One is we have seen one as unsystematic risk and the other one is a systematic risk. So the systematic risk is a risk which is affected by all the companies across the economy. So market wide factors affecting across the economy. So systematic risk. So how much is the systematic risk present in an investment? If it has to be measured, the variable which is used is beta is the variable which is used to measure the systematic risk. Beta is used. I don't know whether you know or not, but for this purpose, I'm saying unsystematic risk is used by standard deviation. So that we are not going to discuss, but some other time if it arises, we can look into that. So at present now, with the concept of systematic risk, we are talking about. So systematic risk, how much is the systematic risk is measured by a variable called as beta. Beta is used to measure the systematic risk. Now the calculated value of beta. Now beta value of a share is to measure its systematic risk and from that predicts the return an investment should require. So the calculated value is taken as if beta is equal to 0. There is no beta. There is no risk present in investment. Beta is equal to 0 is risk-free investment. If beta is equal to 1, the market portfolio has an average risk. If beta is equal to 1, the risk is average. If beta is greater than 1, if it is greater than 1, it is more risky. If it is less than 1, it is less risky than the average risk. So we need to remember what is beta. If there is no beta, no risk in that. Do you see that any investments are there without any risk? Do you know about any investments which have no risk?
No, ma'am.
Any type of investments anywhere? Don't just look at the stock market. Any other type of investment which is risk free?
Ma'am, investment in form of FD.
FD, very good. FD, post office, government issued bonds, government issued market money market securities. All these are risk free. So because government is involved, there is no possibility of a default taking place. So we see that investments are also risk free. Okay. Yes, RDs. So we see that there are certain investments which are risk free. Okay. Beta is equal to 0 is there are certain investments which have absolutely no risk involved in that. If beta is equal to 1, beta is equal to 1, it is average risk, and then greater than 1 more risk, less than 1 less risk. Fine, done. Then if there are investments which have no risk, why wouldn't everyone go and invest in those investments without any risk? Why are that investors are looking at why does this concept of calculating risk and selecting their investment and then adjusting the unsystematic risk with systematic, so much of complication is there. So why should an investor think about investing in an investment with a risk present when we also know that there are certain investments which have absolutely no risk. So what do you think is the reason?
Profit.
Yes. How do we explain that profit? Where the risk is?
Larger. Higher
Yeah.
profit are expected to be high.
Yeah. When the risk is low, return is also low. When the risk is high, return is also high. So there are certain investors who are risk seekers. They want to take up risky investment proposals because their motive, their objective is to maximize profit. because they want to maximize the profit, they look at investments. They invest in those investments which have high risk because they're looking at high returns. Okay, so the return on equity, return on investment is calculated according to the CAPM model as the return on equity says that expected value of return on investment, but the required return from the investment equivalent to cost of equity. So it's specific to cost of equity. So the formula for cost of equity is given as risk-free return. That is RF is risk-free, RF risk-free rate of return. Okay. Then we have a second part of the. There are two parts. First one is risk-free return plus another part of it is there. Another part of it is uh, this is risk premium. The second part of it is this second part of the bracket is called as risk premium. What is risk premium? That is calculated as, see, investments with risk free return also are there. So if somebody chooses to invest in anything other than risk free return, so they are expecting a higher return. So that is the risk premium, the premium which is paid because of taking up risk. So uh, over and above the risk free. Over and above the risk free, because they are investing in some other investment from the market. So any return which they earn from the market, which is over and above the risk free. So the difference between the return which they are earning by investing in the market, okay, and the risk free return is called as risk premium. So when they are investing in some other investment which has a risk premium, some benefit, some return over and above the risk-free return, this also has to be associated with the beta. Beta is the amount of risk which is calculated. So a measure which is used to calculate the risk is beta. So the return and the risk, both of them are multiplied. Okay, so that gives us what is the expected rate of return on equity. So expected cost of equity is equal to the first part of it. There anyway, I mean, a minimum part of it which is risk free return plus over and above they are looking at a premium. That premium comes with the cost. Okay, that comes with a cost. That cost or comes with a risk. That risk is beta. So we are multiplying beta into return from the market minus return risk free return. So that is how we remember risk free return plus beta into return from the market minus risk free return gives us what is um, the cost of equity according to capital asset pricing model. So this is the formula which you need to remember. I hope it is clear.
Yes, ma'am.
I think there's one question we can take it up. Question number 99. We can take up that question and substitute the values. Question number 99. Let's work it out. The equity shares of NICE PLC have a beta value of 0.80. So beta is equal to 0.80. Then we see risk-free return is equal to 6%. The market risk premium is given, is equal to 4%. Then corporate tax rate is given as 30%. What is the required return on shares of NICE PLC? So what is the formula? First write the formula. Return on equity is equal to return on investment or return on equity. You can write anything. RF, risk-free return, plus we have beta. I write it as beta into, it is RM minus RF, but RM minus RF is RP, risk premium. Since risk premium is directly given, we can directly substitute what is risk premium. So simple steps, we can finish it up. So here we have is equal to RF is 6%, plus we have the premium as 4%, beta is 0.8, 0.8 into 4%. Anything to do with the tax rate?
No.
No. Tax is applicable only in case of debt capital. So the value is 9.2%. So to continue further, the next topic what we have is what are business risks? Business risks arise because of two types of risks, that is financial gearing and then operating gearing. So we are going to look into what is operating gearing, what is financial gearing, and try to understand. So what is this concept all about gearing, or we also call it as leverage? What is this concept all about is what we are going to look into. Okay. um, the next topic, we have business risks. Under that, we are talking about what are the different types of uh, costs which are incurred, and what is the impact of these costs on the business is what has to be understood. In the income statement, if the costs are broadly classified based on the behavior of costs, broad classification of costs, we see that there are two different types of costs based on the behavior. Costs which are variable in nature, costs which are fixed in nature. There are certain costs which are variable in nature, there are certain costs which are fixed in nature. So the concept of operating gearing talks about operating gearing is calculated as what is the portion of fixed cost in the total cost. If they spend the total cost, what percentage of their cost is fixed in nature? Fixed cost divided by total cost. So why are we separating fixed cost? By definition, what is the meaning of variable cost? What do you understand by variable cost? What do you
The
understand
cost changes with the sales volume or
with the out
production.
with the production, with the output, with the sales volume? Okay, so a cost which varies proportionately. So any change in the sales, any change in the turnover, there is a change which is seen in the variable cost. But there is a cost which does not vary at all until a particular limit, the maximum limit. Until that limit, there is no change in that cost. So variable cost varies proportionately, fixed cost does not vary. So here, because of that, there is an impact which is seen on the income. Income which is EBIT. So the other day I have given you the format of income statement, isn't it? One day I've given you. Let me put you to the. I'm not able to find that. Nevertheless, I will write once again fresh the income statement. Um, we have sales minus cost of goods sold. Then this is gross profit. Then we have less operating expenses. So this is how we have proceeded further. Operating expenses are deducted. Then we have all the other things, non-operating, incomes, gains, and all that. So we see we have it as EBIT. So this is the format of income statement what we have. But if we look at this format in the sense that what is the amount of variable cost? See, from among the list of expenses which are deducted, some of them are variable in nature, some of them are fixed in nature. So if we do not look at this particular format, but we look at the expenses as variable component and fixed component. So how would we present? We write sales, then less variable cost. Sales minus variable cost. Do you know what is the term called as? The term is called as contribution. So maybe you have not come across, but make a note of that. Less fixed cost is profit. So this is another way of looking at the income statement. So the point is we are classifying them, categorizing the cost into variable cost and fixed cost. So after this, let's see that. Now this is at a, we'll go with an example, okay? Or else let me put it here. This is at present 100% capacity level. So they are operating at 100%. So here, assume that sales are increasing by 20%. So if it is at 120%, so if they are increasing by 20%, so whatever are the sales, it would be 120% of XXX. Variable cost also will be 120% of XXX. Then contribution also will be 120% of XXX. But do we see that change happening in case of fixed cost? The same thing, same fixed cost would be there. And the impact on profit. Let's take an example. We'll work it out in a Excel sheet. I'll put the format in the Excel sheet and then we will work it out in a Excel sheet. For example, um, the income statement has sales less variable cost is contribution less fixed cost is profit. Profit, or what we very specifically call it as EBIT. For example, here 1000 units are sold. One thousand units are sold. Give some figures. Let's take it as 1 lakh is the sales. Okay. Um, so how much would be 100? So the selling price is 100. That's how we get no 2 zeros and 3 zeros, 5 zeros. Done. So variable cost, let's put it at 50 per unit. So how much would this be? This would be 50,000. Okay. So how much is contribution? Contribution would be 100,000 minus 50,000, which is 50,000. Okay. Let's say fixed cost to be as 40,000. So how much is profit? Profit will be, so 10,000 is profit. Let's say the sales are 1,200 units. Sales are increasing to 1,200 units. So if that is the case, then how would the impact be seen? We see that the sales will increase by is equal to 100 into 1,200. Then variable cost also will be 50 into 1,200. Then contribution will be, what is fixed cost? Fixed cost is a cost which remains fixed. So it will remain same 40,000. So the overall profit EBIT will be 20,000. Okay. Let's take a lesser amount of units. If we see 800 units, 800 units. So 800 into 100, the sales revenue will be only 80,000. Here 50 into 8, 5 8 so 40. So variable cost will be only 40,000. Then contribution will be 40,000 only. Then fixed costs are same 40,000. Profit is 0. We see that there is an impact on the profit because of fixed cost. As the sales output is changing, we do not see the profit also moving in the same direction, but we see that because the fixed cost is the same, fixed cost remains the same until it reaches the maximum capacity, it remains same. Because of this item of fixed cost, we see that there is an impact on the business. As the sales are increasing, when it is decreasing, yes, we see the adverse effect, that is there may not have sufficient profits, or they may not even have the profits. So they have to ensure that they sell at least a minimum number of units. So here I think we see that by selling 800 units, they neither have profit nor loss, so zero is their profit. So they ensure all the time to at least sell 800 units. So now above 800 units, as they keep increasing above the minimum level here we have observed it to be as 800 units. From 800, when they move to 1000, their profit has increased to 10,000. From zero, it has moved to 10,000. Another 20% increase, then we see that when the sales have increased by another 200 units, profit has doubling. From 10,000, it has become 20,000. Why is that changing? Because fixed cost is not proportionately changing along with the changes in the sales activity. Along with the turnover, we do not see that the fixed costs are also changing. So gearing is a situation where the firm where the firm can use fixed cost in their total cost. So what portion of the fixed cost in their total is there in their total cost is what is first calculated. The gearing arises when the firm has the ability to use fixed cost in their total cost component. So operating gearing is equal to fixed cost divided by total cost. Okay. Looking at the impact on the income statement, here we understand that what is the percentage change in EBIT when there is a percentage change in turnover. So from 1000 units, if it has increased to 1200, we see that there is an impact of 20% increase in this example. So the operating gearing percentage is calculated as percentage change in EBIT divided by percentage change in turnover. So let's get back to the same example and try to look at. So if there is a the formula for operating gearing is equal to percentage change in EBIT on account of percentage change in turnover. What is the change in turnover? We see from 1000 units, it has increased to 1200. So from 100,000 sales to 1200. So if we are calculating percentage change, so percentage change in turnover is equal to, this is 1200 divided by 1000. You can take with the sales value also. So is equal to, this is 1.2 or 20%. How we can calculate instead of 1200, let's take only. I'll do the explanation here. See, if we see that 1000 units is 100%. 1000 units is 100%. If this is 100%, the difference is, how much is the difference? The difference is on account of 200 units. So this 200 unit change or the difference is change, percentage change. So converting into percentage. So we have 200 into 100 by 1000. 200 into 100 by 1000 gives us percentage change in 1200 minus 1000 divided by 1200 minus 1000 divided by 1000 gives us the percentage change in turnover. We can do it with the figures also, 100,000 and 120,000. The same is the concept. Now coming to what is the percentage change in EBIT is equal to percentage change in EBIT. The same is the logic. The logic would be, now earlier EBIT was 10,000. So if 10,000 EBIT is 100%, the difference of another 10,000 is what percentage? Earlier first level EBIT is 10,000. So this is 100%. The difference, now it has increased to 20,000. So the difference is 10,000. So another 10,000 is what percentage? So how much is that? There is a 100% increase in the EBIT. So here we can write it as here we see 10,000 divided by 10,000. This is 100%. So operating gearing will be here for, in this case, here it will be percentage change in EBIT divided by percentage change in turnover gives us 500%, or if we are writing it in a number format, it will be 5 times. It will be 5 times. This is on account of using fixed cost in the total cost. So gearing is a situation if the firm is able to use fixed cost, more amount of fixed cost. So until a particular level, they have to ensure that their fixed costs are recovered. After that, because the fixed costs do not change, we see that because of that, there is a great impact on the overall profitability. There is an impact which is seen on the EBIT. So operating gearing is a situation which arises because of utilizing fixed cost in their total cost, because use of fixed cost will have a positive impact on the profitability. Okay, that is to run the business, day to day activities, operating expenses. So in case of the operating expenses, when we are looking at that, we are classifying them as variable cost and fixed cost. The second level is financial gearing. So operating, there are activities for a firm that is operating the business day in and day out, the operating activities. Apart from that, they also invest into some investments, and then they also take up financing activities. That is, they raise finances. Okay. When finances are raised, okay, on these finances also, there are fixed costs which are paid, and there are variable costs which are paid. See, the finances which are raised on the cost of capital has to be paid. What are the sources of finance we have discussed? We have the ordinary share capital, we have the preference share capital, we have the long-term debt capital. So there are three different types of capital. That is ordinary share capital. I hope you're able to follow me, isn't it?
Yes, ma'am.
Very difficult to follow. Very difficult to follow.
A little bit.
Okay. But it's not completely going above your head, no?
No, ma'am.
Okay. The recording anyway will be there with you, no? So I think that's the only solace what you have. So you can listen to that again and again, and you'll have some clarity after it. So we see that we have ordinary share capital, preference share capital, and all forms of long-term capital, long-term debt capital we have. So these are the three different types of capital which are raised. So um, in this case, preference share capital and long-term debt have a fixed percentage of return which has to be paid. Debt capital, there is the interest which is paid is fixed in nature. So fixed amount of interest is paid periodically, year after year, period after period. They are paid interest at a fixed percentage. Preference share capital also has a fixed percentage. So one day we have done one question on how to calculate weighted average cost of capital. At that time we looked at that percentage which is given as a prefix, fixed percentage of dividend calculated on preference capital. So there are two different types of capital on which the cost paid on these types of capital is fixed in nature. Ordinary share capital, there is no fixed percentage. Every period it is decided in the annual general meeting about how much of the profits will be distributed to them as dividend. So that is a variable component. There is no fixed obligation. Sometimes in certain scenarios, no amount of dividend is paid even after profits are available. Such situations also we can come across that. So ordinary share capital has no fixed component of dividend. So here we see what is the total. The total gearing is among out of the total long-term capital. All these are sources of long-term capital. Okay, what portion of the capital has a fixed commitment in the form of cost of capital? So we have preference share capital plus the long term debt capital has a fixed commitment. So what portion of their total capital has a fixed commitment? Okay, equity gearing is the proportion between these two versus the ordinary share capital. So we see what is the preference share capital plus the long term debt versus what is the ordinary share capital and reserves. So there is a comparison between what is the fixed obligation, what is the capital where there is variable obligation. So that is there is no fixed obligation. So based on the availability of profits, a decision is taken about how much amount of dividend would be paid. So equity gearing is the proportion between those types of capital where there is a fixed obligation versus those capital which do not have any fixed obligation. Total gearing is the total capital raised which has a fixed obligation, preference capital plus the long term debt capital divided by the total capital. Okay. What is interest gearing? Interest gearing is equal to debt interest plus preference dividend divided by the operating profits before debt capital, operating profits before debt, interest and tax. That is nothing but EBIT, interest earnings before interest and tax. You can make a note of that. So ability of the firm to use fixed capital. Operating is operating fixed cost and fixed cost, operating fixed cost and financial fixed cost. So you might be wondering, what about this? What about this fixed cost? So here, this profit is also called as EBIT, isn't it? So, so from EBIT, we have to deduct less interest, which again is a fixed item. Then we see this is called as EBT. Then taxes are paid. Then we see less preferred dividend, preference dividend. This is called net income of ordinary capital, ordinary share capital. Then less equity dividend. So here in this case, we see that there are two different types of capital, cost of capital, which is interest is fixed in nature. We see preference dividend also is fixed in nature. Equity dividend is not so. So because these two, when there is an increase in EBIT, as the EBIT keeps increasing, these two items, that is interest and the preference dividend, do not increase proportionately. Therefore, we see that there would be an impact on the total amount of profit which is available, okay, which is available to the equity shareholders. So that is more than proportionate amount of profit will be available to ordinary shareholders is the concept, because there are two types of capital on which the cost paid is fixed in nature. Therefore, there would be more than proportionate profit. If there is a percentage increase in EBIT, there would be more than percentage increase in the profit available to equity shareholders, because the interest amount and the preference dividend amount, both of them are fixed in nature. So there will be more than proportionate amount of profits which are available to equity shareholders. I hope it is clear till here. Were you able to see the word file which, where I was writing? Did you see this one when I was writing?
Mm.
Yes?
Yes, ma'am.
Okay, okay. I suddenly got it out whether you were able to see it. Okay, let's continue with the topics. I already discussed this concept, but once again we'll see what is the capital structure and weighted average cost of capital. So when debt capital is introduced, what is the good effect of introducing debt capital? Debt is a cheaper form of capital. Okay. If we put it in a matrix format, um, there are two types of capital. We see debt capital and then equity capital. In case of cost and risk, if we are talking about two different concepts, if you are talking about cost of debt capital is low, the cost of equity capital is high. The risk part of it, risk of debt capital is high, and risk of equity capital is low. So this is the matrix what you can remember all the time. Fine. If the cost of debt capital is low, so if debt is introduced into the total capital, what is the good effect? The good effect is debt is cheaper than equity and would cause the weighted average cost of capital to fall. So weighted average cost of capital is the average of the debt capital, assuming debt on and equity, only these two are there. So debt capital and equity, because weighted average cost of capital is equal to the weight of debt into the cost of debt. Cost of debt is always subject to tax adjustment. So weight of debt into cost of debt into the tax adjustment 1 minus t plus the weight of equity into the cost of equity. So that is the formula of weighted average cost of equity. Now, if more amount of debt is introduced, so more amount of debt is introduced, since the cost of debt is cheaper, it is less. So this will have an impact. So because of this debt capital, since cost of debt is lower, then we see the weighted average cost of capital also to be low. Okay. The bad effect. What is the bad effect of debt capital? Here we see that there is an impact which we can see on account of introducing debt capital, because debt is introduced, cost part is low, advantage is very well, but at the same time we also see that the risk is high, because the risk would rise because of employing debt capital. As the risk increases, the equity shareholders start expecting a higher return, because the firm is now risky, because debt is there, risk is increasing. The equity shareholders start expecting a higher return. So because of the financial risk and would cause the um, KE increases. Why would KE increases? They see that the firm risk is increasing. Why is the risk increasing? Because debt is employed. Because debt is employed, risk is increasing. Because risk is increasing, it is only an expectation. I again tell you, cost of equity, there is no fixed percentage. It is only the expectation and satisfaction of shareholders is important. If they are satisfied, then they continue with the firm. Otherwise, they withdraw their investment from the firm and invest elsewhere. So that will cause some problem to the firm. Therefore, the firm also looks at satisfying the shareholders. So it is to satisfy the shareholders. The company is under an obligation to earn a higher return and pay a higher amount of dividend to the equity shareholders. So it is not explicitly talking about how much would it pay, but it is implicit, it is present there in the scenario, because debt is employed, cost is coming down, but risk is increasing. Because risk is increasing, the equity shareholders expectation increases, so the overall cost increases. So the weighted average cost of capital will rise, because this weight is weight of the debt is increasing, then the cost of equity increases. When the cost of equity increases, then we see that the weighted average cost of capital also increases. So that is what is explained here. What is the impact of introducing debt capital into the capital structure? Debt is a cheaper form of capital. There are certain other advantages, that tax advantage can be availed, but debt has a risk element present because of the fixed obligation, irrespective of profitability and a term period. risk is high in case of debt capital. Because risk is rising, the equity shareholders, the ordinary shareholders' expectations also increase. When their expectations increase, the firm has to pay higher cost of capital in the form of dividend to the shareholders. When the cost of equity capital increases, the overall weighted average cost of capital also increases. I hope I made it clear.
Yes, ma'am.
Any doubts regarding this? The traditional view of it is given here. The cost of debt is a cheaper form of capital. KD is a cheaper form of capital, cost of debt. But because cost of debt is present, the risk is increasing, so the cost of equity increases. So the overall cost of capital, the weighted average cost of capital, balances the two things, that is cost of debt capital and cost of equity capital. So that is overall cost of capital, also called it as WACC. This is another model. Modigliani and Miller without us. Um, we can take it up in tomorrow's class because too much of a content also. I'm scared that you may get confused. I'll see some of the questions which we can solve from the exam kit. Take it up. If this is done, then we've left something in between at the economics part of it. So tomorrow we can do these modular MM model without tax, MM model with tax, and the other aspects. So let's take up one or two questions from the exam kit. Um, A company has 7% loan notes in issue which are redeemable in 7 years time at a 5% premium to their nominal value of $100 per loan note. The before tax cost of debt of the company is 9% and the after tax cost of debt of the company is 6%. What is the current market value of each loan? Okay. Any clue how we can solve? What is the interest? The company has 7% loan notes in issue which are redeemable in 7 years time at a 5% premium to the nominal value of 100 per loan note. We have what is the before tax cost of debt. We also have what is the after tax cost of debt. What is cost of debt formula? What is cost of debt formula? What is the interest rate? 7%. Okay. Interest divided by, they are redeemable in 7 years. So at the time of redeeming, they would be redeemed at 5% premium. So the sale value, the nominal value is 100, but the redeemable value is 105. So the average value will be taken. So we would take it as interest divided by the and okay, face value or sale value. Let's put it as sale value plus the redeemable value. We can write it as interest is 7 because 7% is the loan amount. 7 divided by the sale value is 100 plus the redeemable value is 105. Average of that will be 2. So 205 divided by 2 is 102.5. So cost of debt. No, we are asked about current market value. So current market value, sale value is not what is known to us. So sorry, sale value is not known to us. So sale value plus 105 divided by 2. This happens to be the before tax cost of debt happens to be 9%. This value happens to be 9%. So this is 9%. What is cost of debt after tax? Cost of debt after tax. The same concept, but
6%.
6%. But with the subject to change of tax rate. Tax rate we have no idea, but into 1 minus tax rate. Is the tax rate given? No. So after that, this is given to us as 6%. So SV can be substituted as SV is equal to sale value will be 7 to the 14, 14, 14 divided by 9%. Let's put 7 divided by 9%. Comes to the other side.
Ma'am, SV is 50.55.
You got the value 50.55?
Yes, ma'am.
Huh,
For
50.
SV.
SP is equal to 50.55. Would it be that low? Because the note value is 100. I'm looking at note value is 100. So what did I make a mistake is what I'm looking at. Because the note value is 100. So more or less something close to the 100 value only should be the SV value. So that is what I'm looking into. Because it will be redeemed at 105% more than that. So it will be redeemed at 105. That point is fine. But can it come down to almost 50% discount? No, it cannot be so. So what is that is what I'm looking at. I'm not able to get a clue. Okay. Let me work it out and then get back to you this one. 138. 138, we'll see. TKQ company has just paid a dividend of 21 cents per share and its share price 1 year ago was 3.10 per share. The total shareholder return for the year was 19.7%. We have done shareholder return in one of the problems in today. What is the total shareholder return is, this is the formula. Total shareholder return is equal to, there are two components. One component is dividend return. Dividend return would be they were just paid a dividend of 21 cents. Okay, the share price 1 year ago was 3.10. So we have the dividend return as 21 cents out of 3.10. Then the second part of it is capital gain. Capital gain is the difference in the price divided by the investment at the beginning. Okay, there are two components. One is dividend return, one is capital gain return. So overall, the total shareholder return is 19.7%. So when they have 19.7% return and um, the dividend return, see, this can be written as 19.7 percentage on this side is equal to. On the other side, we have the dividend return, which can be calculated as 0.21 divided by 3.10. Okay, both the denominators are same, plus we have the difference in the price. So the capital gain divided by 3.10. So because both of them, the denominator would be the same. Like I have explained to you here, 0.15 by 2.5, 3 minus 2.5 divided by 2.5. Both of them, the denominators are same. So we can take the LCM and write both the things on the numerator side. So 2.21 is the dividend return, plus they also will have a capital gain. The entire thing divided by, we see 3.1. So 3.1 goes to the other side. So 19.7% into 3.10 is equal to 0.21 plus capital gain. So how much will that be? 19.7.
It's 0.6107.
Okay. Then 0.21 comes this side. 0.8207. Then after that, we also have the 3.10. 3.10 is the beginning value.
$3.5007.
Okay. How much is this one? 19.7 into 3.1.
0.61. Yes, ma'am. 0.6107.
Capital gain comes this side, minus 0.21 is equal to capital gain. So capital gain is basically now,
Ma'am, it is 0.4007.
4007 is equal to capital gain. But capital gain is basically the difference between the current market price minus 3.1. So current market price minus 3.1, that is the price 1 year before, is equal to, we have this value as 0.4007. So 3.1 should go to the other side. So current market value is equal to 0.4007 plus 3.1.
Ma'am, 3.5007.
3.5007. So we can take it as 3.5, round it off and make it as 3.5. So the current market share price is 3.5, the total shareholder return. Okay. Done. We'll wind up the class here.